Welcome back, everybody. Now I want to address a tweet from one of our viewers. It's from Dan. He's asking, Charles, since most invest in mutual funds like Vanguard for retirement, etc., how could you rather have a segment on a good mutual fund? Thanks. Well, here's the thing. I think it's a great question. But instead of recommending a good fund, I want to discuss how you should be balanced and how you should actually go about building your own mutual fund portfolio. You don't have, by the way, to buy all the same mutual funds in the same family. But if you do, you don't want to be fooled by the names, right? I mean, listen, what the heck is the new Galaxy Fund? Now, I'm just being facetious and making that up, but you understand all these different names, and they always turn out to be the same thing. So the first thing I want you to do, check out the top 10 holdings. Make sure you are truly diversified. Also, check the track record over the past 3 years, but also see how the money manager did in bear markets as well. Check your fees, but here's the most important thing. Do not count pennies at the expense of dollars. Don't worry about the cheapest one if it's not performing. Now, here's how I think your portfolio should look. Let's say you had a $10,000 mutual fund portfolio. This is the way I would allocate the funds. Technology, I would have $2,000 there. On the defensive side, it's utilities or telecom, either one, but $1,000 there. Consumer discretionary, Cortez doesn't like it, but I think $1,000 there. Energy might be oversold, starting to bounce here, $1,000 there. Financials, I think everyone in the panel says how much they like financials. I would have be overweight there. And industrial, we talk about the U.S. economy looking pretty good. I like what I saw at Joy Global. I like what I heard from Caterpillar. Industrials, and remember, cash is a position. $2,000 in cash so you can react to what might happen to the market in the next couple of weeks. All right, let's find out what the panel thinks about all of this. Oh, man, I'm a little nervous because we got some of the best on mutual funds sitting with us. I got to start with you, Steve. This is your bailiwick.
Yes, sir.
What do you think about my assessment, and what's something that everyone should understand with mutual funds?
I think with mutual funds, actually, you're very, very right. You know, that you need to see what's actually in the fund, go beyond the labels. You know, that's what Russell does. You know, we investigate those mutual funds, put them together, and also it gives people broad exposure. So things where you may not have the ability or the desire to get an expertise. So you're asking, how does the average guy get into Europe? How do you get into emerging markets? How do you get these exposures? So I think actively managed mutual funds are a great way for people to get into these broad asset allocations in these globally diversified positions.
Jim?
I think you don't want to try to trade them. You want to buy them for the long term. I think cost is an issue. There's got to be.
When you say long term, though, you don't buy them like you don't just set it and forget it like an infomercial.
No, but
how often would I check them?
Well, you can check them every couple of weeks, but I'm saying don't buy it to trade the market for the next month.
I got you.
Look at the cost. You've got there's a big difference in cost. Never pay a load. Some of these funds are still paying upfront load fees, and don't buy them towards the end of the year because then you're going to inherit the tax liability for all the trading they do.
Great point. And real quick, you have one that you like.
Yes, VWINX. That is the Wellesley Income Fund. I love Vanguard. You can't go wrong. Holdings like Wells Fargo, Kraft, Merck, well diversified, like the chart you showed.